Impacts of central banks on the global economy. Analysis of the Fed, ECB, BOJ, and BOE. The Federal Reserve, Fed, implements various strategies to navigate the complexities of current economic conditions. Factors such as inflation exceeding the 2% target, slowing economic growth, and high mortgage interest rates complicate the Fed's policy decisions. Additionally, uncertainties such as trade tariffs and government spending cuts contribute to economic instability. New York Fed President John Williams has stated that the current short-term interest rates are appropriate for bringing inflation back to the 2% target. Williams emphasized that the economic outlook remains uncertain and that monetary policy is well positioned to achieve the dual mandate of maximum employment and price stability. Meanwhile, Fed Chair Jerome Powell has taken a cautious approach toward interest rate adjustments. He asserts that there is no urgency to alter policy stance hastily, considering the current inflation trends and economic resilience. Changes in interest rates directly affect individuals' borrowing costs. Higher interest rates increase the cost of consumer loans, including mortgages, auto loans, and credit card debt. Lower interest rates make borrowing more attractive but can also lead to rising inflation and higher living costs. Government spending cuts may result in job losses in the public sector, adding to economic challenges. Additionally, trade tariffs and shifts in global trade policies could create uncertainties in export-dependent industries, potentially leading to job losses. The Fed's policy decisions extend beyond the U.S. economy, significantly influencing global markets. Interest rate changes impact capital flows and exchange rates, affecting economic stability in other countries. Adjustments in U.S. trade policies influence global trade volumes and supply chains, shaping worldwide economic growth. The Fed's decisions amid evolving economic conditions affect individuals, businesses, and the global economy. As a result, closely monitoring economic developments and making informed financial decisions remain crucial in navigating these challenges. The monetary policies of major central banks such as the European Central Bank, ECB, the Bank of Japan, BOJ, and the Bank of England, BOE, can significantly influence the U.S. economy and the Federal Reserve's, Fed, policy decisions. Impact of ECB policies on the U.S. and the Fed. The ECB's monetary policy decisions can have notable effects on the U.S. economy. For instance, if the ECB implements more aggressive interest rate cuts to combat economic sluggishness in the Eurozone, as anticipated in 2024, this could lead to a depreciation of the euro against the US dollar. A weaker euro makes US exports more expensive in European markets, potentially reducing demand for American goods and services abroad. This shift can impact the U.S. trade balance and may influence the Fed to adjust its own monetary policy to address potential economic slowdowns resulting from decreased export activity. Influence of BOJ policies. The Bank of Japan's monetary policy also plays a role in shaping global financial conditions. In 2024, the BOJ raised interest rates twice, responding to sustained inflation for the first time in decades. Higher interest rates in Japan can attract capital flows into Japanese assets, potentially leading to a stronger yen. A stronger yen relative to the US dollar can make Japanese goods more expensive in the US, potentially benefiting American manufacturers by reducing competition. However, it can also lead to increased costs for US companies importing from Japan. The Fed may monitor these developments to assess their impact on US inflation and economic activity, adjusting its policy stance accordingly. Effects of BOE decisions. The Bank of England's policy decisions can influence global investor sentiment and financial markets. For example, if the BOE adopts a more dovish stance by cutting interest rates to stimulate the UK economy, it could lead to a depreciation of the British pound. This depreciation might make US assets more attractive to investors seeking higher returns, potentially leading to an appreciation of the US dollar. A stronger dollar can impact US exports by making them more expensive for foreign buyers, which the Fed would need to consider when evaluating the overall economic outlook and setting monetary policy. Global coordination and spillover effects. It's important to note that while the policies of these central banks influence the U.S. economy, the Fed's monetary policy decisions often have a more substantial impact globally. Research indicates that the Fed's actions can significantly affect financial conditions and economic activity in other countries, including those in the Eurozone. Conversely, the impact of the ECB's actions on the U.S. economy tends to be more limited. In times of global economic uncertainty, central banks, including the Fed, ECB, BOJ, and BOE, may engage in coordinated actions to enhance liquidity and stabilize financial markets. Such coordination underscores the interconnectedness of global economies and the importance of collaborative efforts to address economic challenges. In summary, while the Fed primarily focuses on domestic economic indicators, it must also consider international developments and the policies of other major central banks. The interconnected nature of the global economy means that decisions made by the ECB, BOJ, and BOE can have ripple effects that influence the U.S. economy and, consequently, the Fed's policy choices.